This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. The particulars contained herewithin were obtained from sources we believe to be reliable but are not guaranteed by us and may be incomplete. The opinions expressed are based upon our analysis and interpretation of these particulars and are not to be construed as solicitation or offer to buy or sell the securities mentioned herein. The opinions expressed do not necessarily reflect those of National Bank Financial.
Okay, we're back.
We are back.
Kenny G, how are you?
I am good. It's kind of hard to believe we're halfway through the year.
I know. Time flies. Time flies.
Yeah, interesting times. It's always seems to get more and more interesting as we go through the piece here.
Definitely. And we have a lot obviously lined up today. Obviously the quarterly update that we're going through. Like you said, lots of things that we'd like to walk you through today, a lot of developing stories, and kind of break through that, shed through the noise, highlight some things that are of concern for us as we step into the latter half of this year. But I also think there's some opportunities out there as well. So as always, going to break it down. Ken's going to go through his portion of his market update. He's going to pass it over to me. I'm going to give you a quick economic kind of backdrop in terms of what's transpiring in the United States, what's happening in Canada, and then also give you some insight as to some other variables out there that are driving a lot of the noise and how that really relates to our mandate strategy moving forward for the remainder of 2024. So without further ado, Ken, I'm going to pass it over to you to go through your segment.
Okay, thanks, Cody. We'll just get rid of that agenda slide and just jump right into the market overview. What I find fascinating out there in the marketplace today is market pundits, strategists, individual investors are just raving about how great the first half of the year has been. Mm-hmm. And you and I share the view that it really hasn't been that great. No. And maybe when you look at it on the surface and you can see the S&P, up 14%, NASDAQ, just under 17%. Yeah, maybe those numbers stand out. But when you look under the hood, it really tells a different picture.
Completely different picture.
So the challenge that we have is if we look at the performance of the markets from the Canadian market to the international markets to the small cap market, we are looking at low single digit returns. And as Cody's going to get into with Nvidia, one stock has accounted for 37% of the rate of return of the S&P 500. And if it was crazy, and we're going to get into that because I think that's a challenge for sure. It's like this, I'm not suggesting in any shape or form that Nvidia is a Nortel, but I think a lot of investors really don't remember what happened back in late 1999 and 2000 with Nortel when it dominated the Canadian marketplace and was year after year for 2 to 3 years, it was the dominant figure, the stock that was producing all the gains. And that's what we're faced with here today. So the other concern is that market strategists are tripping over themselves to upgrade their forecast for the S&P 500. Why? Because as usual, they've been dead wrong. Interesting how Goldman Sachs, they had a target of 5,100 on the S&P 500, and they just upped it to 5,600. Same with Citigroup, they were at 5,200, upgraded to 5,600. But nothing stands out more than the great Michael Wilson And I have picked on Michael Wilson in these podcasts from Morgan Stanley. But Michael, I don't know how you sleep at night, pal, because, it's not looking too good for you. So at the start of the year, he had a target of 4,500 for the S&P 500. So as it moved up, and by May 20th, he was one of the last standing bears. He turned bullish and upped his target to 5,400. Okay. And now the S&P, which hit a high last week of 5,500, or right where that is today.
Yep.
Right? But from his original forecast, he only missed the mark by 22%. So I think there's a lot of challenges out there when you look under the hood. And let me say, this is not an easy environment. And it's so not diversified. The rally that we're seeing is so very narrow. And if you take a look at information technology, yeah, that's a big standout. That's, almost a 29% return. Well, we're talking Apple, we're talking Microsoft, and Nvidia. Yeah. Now people go, well, consumer services, well, how could that be up 25? Well, companies like Meta, like Google, and Netflix get the privilege of being in the communication services. So that is what has dominated the market on the S&P 500.
And they're really technology names.
And they're really technology names, but however you want to
the
paint
global
it.
classification wants to do their thing, whatever.
Those 6 stocks, as you'll allude to, are the lion's share of the market. And then, I don't know about this Canadian marketplace. We've been picking on it for so long, and things definitely aren't improving. We've got a lot of great companies in Canada that produce great dividends. We're just not seeing any clear-cut results. You look at the financials in the United States from the previous slide, they were up 10% year to date. And you look at our financials, which is over 30% of the Toronto Stock Exchange, and they are virtually flat on the year.
Yeah.
And, TD's down 13%. Bank of Montreal is down 11% year to date. You look at the Rogers, the BCEs, the Teluses, they're down anywhere from 16 to 18% year to date. And they had a miserable year
previously, in 2023. Yeah.
2023. So
it's a tough place, and we'll get into that, right? Kind of, it's a blend of politics, and it's also a blend, as I'll touch on, of foreign investment just leaving Canada.
Yeah.
At an alarming rate. Yeah. And so we'll get into that, but I don't want to beat a dead horse, but we've been picking on it for quite some time.
Yeah, no question.
But still, decent results are the high income mandate, as we'll touch on, just beating the TSX. Obviously, a large portion of that is due to the dividend yield. So it is stable. It doesn't have the level of volatility that some of our other mandates have. So it's a portion of the puzzle, as it is with any type of asset allocation. We haven't increased the weight at all. We've kind of just maintained it overall, and that's most likely going to be the continued stance, because are we prepared to get out of financials when the TDs and BMOs, like you said, are down 13%? They still have solid earnings, right?
Yeah.
So it's sometimes a game of patience.
Yeah, exactly. Well, this next chart is one of my favorite charts because it just shows how narrow the leadership is. And you can see that the median, on average, 50% of stocks on the S&P outperform the price return on average. Mm-hmm. But there's 2 key standouts here. Go back to 1988, 1999, just before the tech bubble, and you're looking at 25 to 30% of companies only outperform the S&P. And that's what we're faced with exactly today. what's the concern? Narrow leadership is a problem. So when you have a broadening of the rally, it gives conviction that the upward trend is intact and sustainable.
Yeah.
And we don't have any of that.
we have virtually
in
nothing.
The marketplace today. No. So that's definitely a real concern. And I think that chart absolutely speaks volumes.
And I think it speaks volumes too, as well, I'm also going to allude to as well, is the majority of that, the narrow leadership is just mainly in the tech.
Yeah.
Right? But what's been kind of thrown out with the bathwater is the smaller middle capitalization companies in the United States have gone absolutely nowhere.
Nowhere in 3 years.
Yeah.
Opportunity knocking, perhaps. Another slide that I think is really important is the S&P 500 has gone 377 days without a 2% correction. The only other time we saw that was in the financial crisis. And now, what does this chart tell us? Based on the concentration and not the widespread rally that we'd like to see, the reality is, I think a correction here is right around the corner. A correction technically is 10%. Will we get 10%? I don't have a crystal ball, but I say we're going to get 10. And it could be more than 10. And we're just not smart enough, nor anybody else is for that matter, to tell you exactly when. But this is a long time without a 2% correction. So when you look at the Shiller price earnings multiple, which is, taking the earnings spread out over 10 years rather than one point in time and adjusted for inflation, we're at close to 36 times. That's the second highest in history prior to the tech bubble. When it hit in December of 1999, it was at 46. So this market, in some shape or form, with its narrow leadership in those places, is priced to perfection. And you just take a look at it, and I'm not going to take away his thunder, but I mean, last week we saw about a 16% correction in Nvidia. Okay. Well, it's still up 155% year to date, and over, go back to 2021, it's almost up 600%, which is staggering. And you look at the amount. You just take a look at Australia, Korea, Germany, and touching in on Canada. I mean, Nvidia is worth more than the GDPs of the market caps of these countries, which is absolutely crazy.
It's hard to even fathom,
to
be honest with you.
And what I find fascinating is, and people just, they get caught up in it. It's like I vividly remember doing a seminar down at Marine Drive in 1999. Nortel is trading for $124 a share, and I make the mistake of bringing in Dunnery Best. That was at Midland Walwyn at the time, and he told everybody in the room, hold on, because it was going to $200 a share. And that's the kind of thing I see today with Nvidia. And it's tough because you've made a lot of money. And back in 1999, clients, please remember, you were given BCE. You had BCE. It was a spin-off from BCE, and your adjusted cost base on Nortel was zero. When it hit 124, nobody wanted to sell and pay the capital gain tax. And then we have Dunnery Best telling you it's going to 200, and we all know the demise that has happened. But another way to look at this outlandish story is, rather than price to earnings, take a look at price to sales. When you look at price to sales, the historic average of the S&P 500 is 1.6 to 1.82 times sales. And it's only been at 3 once in history. And 3 is deemed to be high risk.
No doubt.
Okay. You've got those numbers, 1.6.
Is the average.
The average to 1.82. Anything over 3 is deemed to be high risk.
Crazy valuations.
This stock trades at 23 times sales. And as one of our great portfolio managers from Poland Capital, Dan Dovicowicz, has said, this thing is priced to perfection, and a lot of amazing things have to go right to justify paying 23 times sales for an individual stock.
Yeah.
So you briefly talked about the opportunities. I pick on analysts all the time, but there's a great analyst out there. His name is Tom Lee. He was educated at the Wharton School of Finance. He's an accountant by trade, and he's got the call on the markets incredibly right over the last several years when people have gotten it wrong. And what he said in March, and he's reconfirmed his conviction, is if you take a look at the Russell 2000 small mid-cap market, you can see that it's virtually flat on the year, which you talked about, and then it's down almost 8% over 3 years. And Tom has the conviction, and I know it sounds outlandish, but this guy's been right way more than he's been wrong. He thinks that the Russell 2000 has the potential to rally by 50% by the end of this year. So, yeah, are things overpriced and are there challenges in the market? Absolutely, but there are some opportunities as well that are, presenting themselves in the market. This geopolitical risk situation isn't going away. I've spent a lot of time talking about it. We all know what the geopolitical risks are, but then when you have Putin and Kim Jong-un making a security pact that they are going to unite forces should any allies attack them. Wow. That's a challenge. So these political risks in Hamas and Israel, they're not going away. We don't hear about the Russian-Ukraine war nearly as much as we used to, but these problems are still prevalent. Not to say that we've got the surprise election coming up in France, and then I'm not so sure you want to tune into this because this is way too early. As we all know, the U.S. election is in November, but what's happening this Thursday night? Good old Trump and Biden are going to spar off against one another for the first debate. What month are we in? And it doesn't happen until November. This is absolutely unprecedented. So I think volatility is going to massively increase in the third and fourth quarter. That is our outlook. We think the closer we move to the U.S. election, the more volatile we get. And if this very narrow leadership falters in any shape or form, you're going to see a correction, and that's what we're calling for.
Great. That was perfect, Ken.
You're welcome.
So, quick economic overview. I just want to give some highlights of some recent developments, mainly what's transpiring in the United States and specifically in Canada. Not really going to focus on international markets, kind of just want to stay more concentrated in North America. And there's obviously been a lot of news, inflation figures, employment, walk you through some of that noise and kind of see what we're kind of forecasting for the remainder of this year and heading into early 2025. So the first kind of developing story is specifically in the United States is the jobs number in May came out, 272,000 jobs were added in May. And when anybody sees a figure like that, you expect, oh, well, hey, America is doing great, right? But if we take a step back and we actually look at the full-time employment, okay?
Yeah.
There's actually been quite a big contraction over the last little bit. And so what we've seen is for the 5th consecutive month, we've seen a contraction in full-time employment, bringing the annualized growth rate down 1% so far this year.
Yeah.
And that doesn't seem, like when I say contracting 1%, like that doesn't seem big, but just to put that into perspective, this is the largest ever recorded decline in full-time employment outside a recession.
Yeah.
So it is meaningful. It is meaningful.
With higher rates, employers are,
Employers are cutting, and a lot of
people
people are shifting to part-time work.
Yeah.
Right? And so we live in a gig economy. Things are changing, but obviously not having full-time employment can articulate itself into wages. We've seen wage growth come off substantially. And how does that kind of affect the consumer at the end of the day as well? Right?
Absolutely.
And so that's kind of the next slide is if we take a look at the U.S. consumer, what we're seeing is the resiliency that was there in 2022, 2023 is kind of fading.
Yeah,
Okay.
definitely starting to fade.
So first quarter U.S. GDP came in unrevised at 1.6%. They actually revised it down to 1.3. Okay. So yeah, 0.3% reduction in terms of the growth rate. Sure, it's not too drastic. But what's interesting to note is all of that revision was consumer spending. So what we've seen is the momentum of consumer spending is coming down quite substantially, which, as we well know, I don't want to sound like a beaten record, but the U.S. economy, 70% of GDP comes from the consumer. So this is a very, very vital part of the U.S. economy and its ability to hold up. But what's interesting is also from the U.S. consumer standpoint, and the reason why I think we're also losing momentum is all of those excess savings that we built up during the pandemic when we couldn't leave, we were strained in our houses, they're gone.
They're gone.
Everything is gone. So now what's left is the U.S. consumer has a couple options on their hands.
I don't know what the Feds are looking at because they are not looking at the last 3 charts.
I don't think so.
Yeah.
Because things seem a little rocky ahead for the consumer.
Yeah.
So you have no savings. Wage growth is coming down, so you can't really rely on your wage to supplement your spending. So you can either borrow and credit.
With the rates the way they are.
Yep, exactly. Or you can try and, like I said, there's strong wage increases, which I don't think we're going to be betting on that since we've seen the downward trajectory. Or you just maintain a low savings rate regardless of your circumstance, which is not the best scenario.
Yeah, not healthy.
Right? But in all of those cases, it's a very challenging environment, I think, for consumer spending and AKA consumer resilience to maintain moving forward. And I think ultimately that's going to put stress on U.S. GDP moving forward over the coming months. Right? And so like I was saying, don't have excess savings, but you just want to continue to spend. Where do you go? You go to your credit card.
Yeah.
Right? But what we're seeing...
Or the bank of dad.
The bank of dad. Yeah, parents.
Yeah,
totally. But what we're seeing here too is, just from a credit standpoint, is we have credit card delinquencies at the highest level since 2011. And we have auto loans, delinquencies, people defaulting on these things, the highest level since 2010.
Yeah.
It's not a pretty picture out there.
No. Right? I don't see what picture the Feds are looking at. But
still at restrictive territory. So I think if we do see this continued loss of consumer spending articulate itself into the remainder of the year. Hopefully the Fed's not too late to start actually pivoting, cutting rates, being less restrictive, because if they don't and hold on for too long, then that becomes an even more challenging environment to fix.
They took the punch bowl away far too late, so they got it wrong on when to tighten, and they're probably going to get it wrong on when they start to drop rates.
They overdo it on both ends.
Tightening, and another governor said today that she hasn't ruled out another rate hike today. Yeah, and there's only 2 Fed meetings left. Right,
I wonder how some of these
one in
people
September
get in.
and one in December. So I
don't know what the requirements are to get into the FOMC committee, but
yeah, actually, that should be my next career, your next career. Yeah.
So just flipping over to Canada, the inflation figure actually just got released today.
Yeah,
it was higher than what most people anticipated, but I still think the moral of the story here is Canada's widespread inflation problem has been eradicated.
Yeah.
Okay. We are down, if we take out mortgage interest costs, we take out rents from the inflation picture, we're in and around 1.3% inflation.
Yeah.
We have not, in terms of our 3-month change of CPI and the number of categories, over 2% inflation.
Yeah.
We're back to normal. So I think that, like I said, that widespread inflation has been solved. The Bank of Canada has done its job. They were the first to cut, as we were talking about.
Yeah.
The things that we talked about in our last podcast was Canada has to cut the first, they have to cut fastest, and the deepest.
Yeah.
So we are right on cutting first. They're the first G7 country to cut.
Yeah.
But I think the pace needs to substantially catch up. Because what we can see as I move on to the next slide is even with the most recent 25 basis point cut, the Bank of Canada still remains the most restrictive central bank in the G7 in terms of a couple different things. Our current policy rate to the actual CPI.
Yeah.
Okay. So out of the G7 countries, we still have a very restrictive monetary policy, even though we have a very our inflation outlook has come under pressure, right? So still restrictive on that front, but we also have a softening labor market compared to the rest of the G7 as well. A lot of that was with the population boom that we were talking about in our previous podcast. But if you take a look at the gap between the unemployment rate and accelerating inflation, we're also the most restrictive there. So the long story short is, yes, we were first to cut, but I think that the Bank of Canada needs to continue that trajectory onwards. Otherwise, we may be in for a little bit more trouble.
I mean, if they just do it a quarter at a time, they need to take 50 basis points and, accelerate this thing before it's too late.
Exactly. And it is, speaking of getting too late, what we're seeing is, especially in terms of our respective stock markets, I've been through this before, but that divergence between the S&P 500 and the Toronto Stock Exchange is still at a record discount.
Yeah.
Right?
Staggering
discount in terms of the valuation of our two markets. And a big reason to why this is happening is, yes, our economy has been weaker than the United States, but also what we are seeing is a substantial outflow of foreign investors. Yeah. Foreign investors want out of Canada so badly.
So do I.
To the point where literally foreigners have dumped, and the number is exactly $37 billion.
That's astounding.
Worth of Canadian equities over the past 12 months.
Is it any wonder?
Any wonder, right?
And it puts the pressure not only on the stock market, but that puts the pressure on the Canadian dollar.
And so the trend, as you can see on the slide, has been observed since 2023 and continues. But what's interesting to note is it's never occurred. Usually it occurs during a recession, 2008, 2020. But we have this large outflux of essentially foreign capital over the last year and a half here.
Do you think Freeland and Trudeau have ever seen this chart?
I don't think so.
No, I don't. I don't think so.
But that's what it's all about, right? Is foreigners are less confident with our political regime, the corporate taxation, talking about our energy transition, how is that going to work out? And then also just how restrictive we are in terms of, as we've already been through, out of the G7 countries, and that affecting corporate profitability.
Yeah.
It's a tough pill to swallow in Canada. So that's just the quick economic outlook. I wanted to transition quickly just so we kind of get through this in a decent amount of time and don't take up too much of, hopefully, the sunny day, is going through some noise that's in the market. And the whole purpose of our podcast is beyond the noise. I want to tell you what's out there and how we kind of make our way through it. So Ken already touched on this, but I want to give you kind of more of the details behind specifically the United States and the massive market imbalance that's happening with the S&P 500. So what we have up on the screen here is the left-hand side shows you the S&P 500, the leading contributors, their rate of return, and then the contribution to the S&P 500 for the year thus far. Okay? So from January 1st till June 21st, the S&P 500 has returned 14.6%. Nvidia, you already showed the staggering 155% this year. Well, guess what? It has accounted for 4.77% of that 14.6% rate of return for the S&P 500 for one stock.
Out of 504.
Accounting for 33% of the entire gain for this year. And the picture gets even worse if we include the top 10. The top 10 names have accounted for 75% of the rate of return on the S&P 500.
Yeah, and the ETFs just keep flowing into this, and they don't consider valuations whatsoever.
No, but that's challenging. That's challenging, especially for us too. When our U.S.-focused growth mandate, we're up 7, but it's tough when our benchmark is the S&P 500 and you don't own Nvidia because your portfolio manager has the conviction, right?
He's not willing to pay 23 times sales.
Yeah.
And you shouldn't be either.
Definitely not. Every growth has its price, and you have to be disciplined on that. And that's why we obviously rely on our third-party managers for that conviction. It's their job to do that research. We sit and look at the macroeconomic view.
And when it unravels, we're going to be happy.
Exactly. So I think an important thing to highlight here is because the S&P 500 is market cap weighted. So the larger the company, the more effect it has on the overall performance of that market. Okay? Hence why Microsoft, Nvidia, Apple, the top 3 names on the S&P 500, if they do well, the S&P 500 is going to do well, right? So, but the thing is, it doesn't really give you a sense of how the other 497 components have done. So an interesting benchmark that is utilized by a lot of professionals is the S&P 500 equally weighted benchmark, which essentially doesn't use market cap, but each stock on the S&P 500 has its own weight, and you are able to see how that basket of 500 securities has performed, giving you a larger breadth and knowing how the U.S. market is done. Over this year, it's only returned 4.5%.
Just in line with all the other markets.
Just in line with all the other markets in the world. Exactly.
Yeah.
S&P TSX up almost the same amount. MSCI just under.
People get caught up in the noise, and that's why we call this, beyond the noise, and what we try to do is look under the hood. But all last week, all you heard about, like, you take a look at Apple one week, Microsoft the next week, Nvidia last week, all jostling for the top spot. And it goes, and that's where the story lies. What's important is not what's in the headlines, what's underneath, and we're trying to bring a flavor to you about what's underneath.
Exactly. Looking under the hood is super important. So this just goes to show you how concentrated things are. And Ken already brought up how there's no breadth in the market. And you looked at, obviously, the number of companies beating the index on an annualized basis. If we break that down on a month-to-month basis, actually we set a record. Just 19% of U.S. stocks managed to outperform the wider market last month. The worst breadth in 20 years.
Hold on to your hats.
Concerning. So with this massive rally in Nvidia, the tech stocks, there is a big sense of FOMO.
Yeah.
FOMO, the Gen Z way of saying fear of missing out, for those of you that aren't into the acronyms.
Or are my age.
Or your age,
Yeah.
politely and respectfully.
Just taking care of you, my younger clients like myself. That one was for you.
But there's a lot of FOMO out
Yeah.
there. And I think this chart goes to sum it up perfectly. So last week, tech stocks saw the largest weekly inflow ever on record. In 1 week, $8.7 billion worth of funds flowed into tech.
Speechless.
That's fear of missing out, right? And what's interesting to note too is we also, if we take a look at, this is a survey that's conducted with a lot of fund managers in the United States, and it shows their levels of cash in their portfolio at different points in time. And what's funny to note is you can pinpoint we circle the points where they had the highest levels of cash, and what's funny to note is every single one of them is the buying opportunity, and you have the highest level of cash, right?
That's why we're contrarians.
It's very much a contrarian indicator, right? But what we can see is cash levels by most fund managers, because they got it so dreadfully wrong in 2023, they're trying to play catch up. And 2022, right? They're trying to play catch up right now. And that's why their cash levels, inflows into tech, keeping cash levels small and hoping this thing persists. But that is, in our opinion, a very dangerous game.
Absolutely.
But it's a game, I think, of this at this point in time where we live in an environment where now it's just a game of momentum. What's trending? What's hot?
Oh, yeah.
What are you missing out on? And is essentially where people are allocating funds to. And this speaks for itself, right? So this chart shows you for 2024, the different factors that have performed the best. And when I'm talking about factors, we can talk about different kind of elements that can contribute to a specific rate of return. So how has value done? How have dividend stocks done? How have growth stocks done? How have quality done? Low volatility stocks. But what's interesting to note, like I said, momentum running the game, is momentum-based strategies have performed the best in 2024. Mm-hmm. Momentum is the name of the game right now. But what happens when the music stops?
And the momentum moves the other way.
And the momentum moves the other way, right? And so I don't like to pick on Nvidia. I think it's probably going to change the world. But just like the dot-com bubble, every great company has its limits in terms of what you're paying for it. So the FOMO is rampant in that stock right now. 90% of analysts have a buy recommendation on Nvidia. And insiders at this point in time are liquidating and dumping their stock at the fastest pace we've ever seen. So when the momentum shifts, and if it does shift,
I think when it shifts,
there may be some severe devastation across the board here. And I'm hopeful that, especially as I'm going to allude to in the next slide here, the smaller names that haven't essentially gotten the glory aren't necessarily going to fall victim to the large decline that's happening there, and will be able to offset some of it. But very, very interesting dynamic that's transpiring, and a lot of noise out there. So just moving on, very quick here. I know we got to be pressed for time, but quick mandate review, walking through each strategy. So starting with our fixed income mandate, the fixed income mandate is holding in there. It's been a pretty volatile year for fixed income. We had 6 projected rate cuts by the Federal Reserve to start the year. That dissipated to 1. So everybody propping up fixed income being a place of great returns, again, kind of is disappointed. Our mandate, still almost 1% better than the benchmark overall, is up 1.42. Bear in mind, we are collecting a very good yield on that. And most importantly, it will provide significant cushion should we see some of the things that we were talking about come to fruition.
You just got to be patient with the mandate. It's when rates drop and when we think this market rolls over, you're going to love your waiting in the fixed income mandate.
Definitely. Verus high income, Canadian equity, dividend orientated, up 4.5.
Hey, if we can double that in Canada and we get close to 8, 9, we'll be happy.
We'll be happy with that. U.S. focused growth leading the way. Obviously, still that mandate is tech heavy, doesn't have an Nvidia in it, but it does have the Amazons, Microsofts of the world, which have still done phenomenal. It's trailing a little bit, but still up 7.24%. It did 40% last year. We did take some profits from it in February, where it was actually a bit higher than it was at this point in time. So really hasn't gone anywhere, but still performing well. U.S. small cap has come under pressure. As we've already shown you, the Russell 2000 over 3 years is negative. We think that there's some substantial value to be had here if those mega caps end up selling off. I think smaller middle capitalization companies are going to have their day. Like you said, Tommy Lee thinks there's going to be 50% increase by the end of the year in small to mid caps. And I think if there's any opportunity knocking, as I'm going to show you on the next slide, it's there.
Yeah, and what you need to understand is a lot of professional money managers, they get paid to have money in the market, so they're not going to raise cash. They're going to go to areas where they perceive value. And certainly the small to mid cap presents a wonderful opportunity today.
Definitely. And on the international front, just kind of in line, this mandate was up 35% last year, flat for the year. It's been a challenging environment in Europe and some other places internationally, but virtually flat for the year. Lastly, our alternatives mandate, slightly positive for the year, still remaining significantly uncorrelated. Ken, as you mentioned, with the fixed income mandate, it's about patience. The same thing applies with the strategic alternatives. We need to be patient. It's there to preserve capital.
It's going to protect your bacon on the storm that's on the horizon.
Exactly. So that's a quick mandate review. The performance reports are going to come. You're going to see all of the actual results for the quarter year end. The fact sheets will all be uploaded so you can have full disclosure on each one of our mandates. So just moving forward, we've kind of already touched on this. In terms of our strategy moving forward, I think there's definitely some opportunity knocking. Not going to sound like a beaten record, but specifically in the small cap space. And I think this graph goes to kind of sum it all up. Okay. So this graph shows essentially the return differential between the Russell 2000 and the Russell 1000. Okay. Where you can see where small caps are expensive and where small caps are cheap.
Yeah.
Okay. And this dates all the way back to 1980. So 1980s, small caps are expensive. We get the massive decline all the way to essentially the tech bubble, where at that point in time, small caps hit their cheapest valuation.
Yeah.
Get a rebound after the tech bubble, large caps collapse. But then we start to slowly see that come down to the point in time where now we are close to small caps from a valuation perspective being at historically cheap levels, almost back to that tech bubble. And a lot of things are kind of aligning. We're not saying it's the tech bubble in any shape or form, but a lot of things are kind of rhyming in terms of the charts that we're showing you, right? So will we be allocating a little bit more to small cap? I think so, over the next coming bit. The timing of it is a little bit unknown, to be quite honest with you, but don't be surprised if we are sending out some commentary and some emails to all of you telling you that we are going to be increasing the small cap space, because I think there's some substantial, if there's mean reversion that happens here, it's going to benefit every single one of our clients substantially. So also part of our strategy moving forward, and I think part of our strategy besides us doing the work, obviously we have the fiduciary duty to all of you to take care of your assets, but also we have a responsibility to also manage your emotions. And what Ken and I want to do is, Ken already said it, is we kind of want to prepare you for the volatility that's about to unfold. Okay? And right now we're living in a very, I would say, I don't want to say different time, but a very volatile time where we have access to information at the drop of the hat. Computers are trading through algorithms like crazy, and volatility is enormous.
Yeah.
And this chart just goes to show you where on May 1st of this year, at 3 p.m., 1 hour before market close, the S&P 500 was up 1.13%. Historically speaking, over the entire course of the stock market's history, it had a 99% probability of closing positive for the day. 99% probability. And what does it do? It loses all of it after Powell opens his mouth and plummets.
Yeah.
Right? So that's the volatility we're faced with. And I think that it's going to continue to pick up as we head into the election cycle. And historically, what we can see through an election cycle, if we look at it, is there's actually a 25% increase in volatility over the months leading up to the election in November. Then we get a steep drop off once there's certainty as to what the political regime may be.
And that's going back to 1928, not counting even Trump.
Yeah.
Into that period. So hang on here, folks.
So volatility is, as we always say, volatility I think is going to be here to stay. It's going to ramp up. But like I said, the whole point is managing your emotions here. Yeah. Because as we look beyond all the noise that we've talked about, yes, our job is to make those tactical shifts, protect the legacies of your families. But it's also important that we remain invested. Through all these different points in times, through the different crises, through the different election cycles, all these events that have transpired from 1968. The market is resilient. The only real risk is you liquidating and being emotional. So we are here. A large portion of our job is to obviously guide you through that. There may be some hand-holding, but we will definitely get through this all together.
Yeah, and your tactical asset allocation comes in.
Exactly.
And that's why we're proactive rather than reactive, and we're already preparing for the storm that we see on the horizon. And with any storm comes an opportunity.
Exactly. So
right?
we've been proactive. As I don't want to sound like a beaten record in terms of the other podcasts that we've done, but in February of this year, when markets were red hot right at the beginning,
they dropped in April.
We raised levels of cash. We trimmed our profits in U.S. focused growth in international markets. We raised some fixed income to start preserving some more capital that will lay ahead, right? And I think if I'm foreshadowing as to what our strategy here is, we are looking at raising even more levels of cash at this juncture. I think a slight uptick might be necessary if we continue to see this FOMO persist. And we have no problem taking some allocation in terms of our equity exposure off the table and putting a little bit more into cash that's yielding 4.5% at this point in time, right? Mm-hmm. To give us the opportunity, if things unravel, to buy, right? So we have it all articulated. We've made some good steps so far, probably some more to come, but we are taking it day by day, as we always do. So just some administrative items. For those of you that are unaware, Carmen is actually on maternity leave.
And she had a baby boy, 7.1 pounds last
so
week. Congratulations,
Carmen. Congrats to Carmen. So she'll be gone for a year and a half. So what we have done, and we're pretty excited to do so, is we've had the capability of onboarding 2 new individuals with tremendous amounts of experience onto our team.
Yeah.
Okay.
Big value add.
So the first is Irene. She has been in the industry since, I think she actually started at the BMO branch in 1985. Same year you started.
I mean, there's only a few of us around, so.
So Irene's been around for a very long time. She's worked with an advisor here who recently just left for the last 15 plus years. So she is here to essentially help from an administrative standpoint, replace Carmen for the time being, and hopefully be obviously a part of our team even when Carmen returns.
Yeah,
right?
that's definitely the plan. And she's very seasoned, so
definitely,
and great on the phone as well.
Exactly. Next, we have Glenn, also was with the advisor that left. And Glenn is also an industry veteran. He is definitely going to be able to help us out in terms of all of our reporting, our trading that needs to be done, a lot of things that essentially alleviate some time for me.
Yeah, Cody's going to get less gray hairs now thanks to Glenn. So we're really welcome to onboard.
But yeah,
Glenn.
very, very happy to have Glenn. Brings a tremendous amount of experience to our team. And then last we have Virginie, or V for short. She is part of our development or business development. So she is the one behind the screen right now, creating the podcast and all of the email marketing that we get out to you, keeping you informed. She's a big part of that. And we're happy to have her on the team as well.
Yeah, big part. And you see those slides. I mean, I throw a slide at her earlier today. It's not legible. In 5 minutes, it's come back perfect. So I don't know how she does it, but it's fantastic.
So yeah, new team members, exciting. And then just some additional things for you as what to expect. Quarter is approaching on us. So what you'll receive is the performance and holdings report. Ken will be following up with a call.
Yeah, I've already started. Mm-hmm. I've talked to at least 15 people. I will be calling to go over your QPR. It's a difficult time to get a hold of people only because it's the summer. I've left messages and haven't heard back, but I will continue to try as many as I can, and failing if I can't talk to you, I will send you out an email summary. But I'd like to have the opportunity to have a quick chat with you. I know it's the summer. I won't take much of your time, but I think it's important to connect.
Definitely. So those reports will be sent to you most likely the second week of July. We're going to try and get them out sooner, but we have to actually get the performance figures in, let the fees hit so you can see your actual returns net of fees, which is super important. So that's why there's a couple delays right after the quarter.
The fees don't hit till the 11th to the 15th of the month. So we have to wait because we want to give you your net rates of returns.
Exactly. And then the last thing that's going to come out is our wealth notes for June. So it's going to be kind of a summation of this podcast, probably in a little bit more detailed format. So those of you that like to read them, it'll be coming along with the quarterly performance package. So that's
Yeah,
pretty much
just
it.
one more reminder. If you want to mark your calendars, we are doing a luncheon down at Marine Drive on Thursday, October the 24th. So we'd love to see a lot of you there. And we've got some new clients. We'd love to see you there for the first time and introduce you to all of our wonderful clients. So please mark your calendars.
Perfect. Alrighty.
Okay, there we go.
There we go.
Let's,
Another quarter down.
strap on our seatbelts
Exactly.
and get ready for
Get ready
the
for the
last
next
half
one.
of the year.
Alrighty.
Thank you very much for listening.
Thank you.